Good morning, good afternoon, December the 3rd. It's Wednesday, and markets are up this morning. ES and Q, RTY up. Had a good, solid day for tech stocks last night, but you can see the other sectors were lagging slightly. But I think that's a good thing because we've had the opposite, and now we're seeing a little bit of a flip. It just basically tells you that there's a bit of rotation happening in the market. So I perceive that as being good. Brent a little bit higher with nat gas, copper, gold, silver coming off a little bit, palladium. So a little bit mixed in precious metals. FX also a little bit mixed on the indices, bit choppy, no real clear themes. But I think, as we'll talk about a little bit later, the kind of few day trends that we've been seeing, or even maybe a week-long trend, which was to mainly be short dollars. I think it's time to start kind of reining in on that bias and start to think about two-way risks. So we'll take a deeper look at that. Today we have the ISM PMIs being the big one, ISM services, and we had ISM manufacturing, and everything was soft there, but prices are still strong. And the last time we had 70 print for prices, which is, pretty much at the top of the band. So if that continues to be there, even though it's slightly softer, it's still an issue. And I think that could weigh in. And obviously, if that's still an issue and, other services components are good, then that could create a little bit too good is kind of bad news type of situation. And we could see the dollar put in a short-term rebound and things like that. So that's kind of my thinking for today in terms of my my trading sort of view on the day, the short-term trading view. So with that, cover the news flow real quick. So we're seeing, as we saw yesterday, we're seeing a lot of Bitcoin headlines, and was getting very contrarian vibes. And now we put in a really nice strong bounce from the 84K area, and that was that consolidation range. It was a tight range after last week's low that eventually broke to the upside and got back to where it is now. In fact, not as high as where it is now, and putting in a low there, a higher low there, as we got this other bruising sell-off is very, very encouraging to me. So I'm loving Bitcoin. I rarely trade it, but just sometimes as traders, we go with where the opportunity is. And yeah, I've been trading a lot of Bitcoin lately. So Bitcoin, great action, great volatility in markets lately. It's been fantastic in my opinion. Yeah, so Bitcoin looks pretty good. More stuff on the Oracle CDS. Good to keep in mind that that's a very illiquid market, but sentiment is very one way, and so you're seeing these sorts of headlines where the CDS rate is ballooning or spiking higher. But then we're having Anthropic picked up IPO lawyers, and so that's pretty strong intention that they're planning to go IPO. OpenAI has yet to make such steps yet. I'd imagine they would at some point. But overall, I think these AI companies IPOing will be supportive for risk sentiment. When they IPO, who knows? Because, that's when you see a lot of private investors take their winnings because, that's their exit. They fund early, and their end goal is to IPO the stock, and that's usually when they take the bulk of their winnings. They might retain some, so it could be whipsaw. We could see some weird action at the end, and who knows how that's going to go. But for now, I think the chatter of these IPOs coming in will be supportive for the AI infrastructure type stocks. If AI stocks are expected to IPO and there's going to be a bit of buzz around it, then related stocks will also follow the hype too. So I think it will be quite supportive. China services, another PMI out today, business survey, private sector business survey, and still not so great. So same narrative that we've been hearing. And GDP, Australian economic growth misses forecast, RBA bets whipsaw. And the thing about GDP is it's extremely lagging, so it's very difficult to take away too much from this. But what we're seeing in more recent data is that the fundamentals are quite strong. Business confidence, the confidence surveys, the PMI surveys, the labor market, and inflation, they're all very strong. So yeah, I think that could just be ignored. Bond sell-off may extend as hawkish RBA bets emerge. Yes, so this is probably the bigger point to kind of take away. And Swiss inflation unexpectedly slows to zero in challenge for SMB. I think we sort of expected this. It was always going to be a risk that Swiss inflation would be the first to get back to zero, partly due to a strong Swiss currency, right? You have a strong Swiss currency that makes everything expensive, and therefore you just don't have that kind of inflation, price rises, because it's already too expensive. They can't hike the prices in domestic prices out of Switzerland. So it was always going to be a risk, and so now I kind of wonder whether it's slowly building up towards this watershed moment where the S&B has to balance things a little bit more. Can't let that Swiss strength get too out of control. Make sure that the Swiss doesn't head back into deflation. That there has to be a little bit more balancing from the S&B. I know that they have been doing a little bit of that, but yeah, I mean nothing too meaningful. So it's an interesting point to keep in mind. Maybe you know, yeah, I mean Swiss shorts could probably, and I dare I say, could be a big thing. You look at the Swiss index charts, you look at Swiss yen, for example, it's just been ripping, right, for like years and years and years, maybe a decade-long rally. So very, very strong. And yeah, just something to keep in mind. Commodity news, silver coming off record highs. Do like that chart. I do like how it's had a pop over Monday's high, I believe it was. Just kind of had that little sweep above that high, and then it's just kind of retraced it. Oil, the chart's still looking pretty good, in my opinion. I think it's not bad for a side bet, for a swing trade, higher. And as Angus just posted earlier, the latest headlines is saying that they're probably not anywhere close to a deal that other headlines have suggested. Surprise, surprise, Angus said. Yeah, no surprises there. Like I said, I just don't see it. Zelensky, Putin, they want different things, and they're stubborn. AF. Don't see a compromise being made. So, yeah, I think the upside risk is always going to be ever present in oil. And at these levels and a decent chart, when you're looking at it from a big picture sort of view structurally, we people have been pointing out that lag kind of consolidation, that descending channel. I think it's starting to look, it's a good bet. And then I feel we need to cover this because Twitter or X is losing their mind over this. Fed injects 13.5 billion via repos as QT program ends. Second largest liquidity boost. Are we watching the first signs of QE returning? Etc. 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 Goodness me. This really has to be put into context. QT has brought some strain, and QT, just to put it loosely, it's all those bond purchases that they've made over the pandemic period to suppress yields and longer term interest rates, to suppress mortgage rates, to suppress, borrowing rates, things like that. That's done. That's kind of been rolling off for some time, and it's finally ended. And this is normal. Even Powell in his press conference said, there's a framework for this. This is completely expected. And that's what happened. This is just very typical of what happens when you drain reserves from very, very high levels as a result of QT. And that's just causing some dislocations in short-term funding markets. So the TLDR is that this injection isn't a surprise. It was somewhat expected. And because they were getting what they were seeing according to their framework, they've gone out to do what they're calling risk management purchases. But it most certainly isn't QE. Well, like a lot of people are thinking about this, liquidity is such a buzzword, especially in crypto, right? Liquidity drives everything, but it really isn't that kind of liquidity. It's just liquidity in the short-term funding markets to ensure that they're isn't any dislocations, and you see these repo rates spike, and it gets everyone's attention and makes people antsy, like there's something broken. But this is to ensure that nothing is broken, and to maintain the status quo. That's basically all it is. Most certainly not the money printer going burr, or as this guy is saying, the money printer isn't paused, it's warming up down at the bottom here. So that's all it is. I think it's just we're saying that this injection into short-term funding markets is completely another planet to treasury yields of which the money printer operates, right? The QE is buying treasury bonds to suppress yields. And by suppressing yields, valuations are likely to go higher because they have a cheaper discount rate, and it supports the housing market, it supports lending activity, borrowing activity because interest rates are kept low. So things like that, right? It's a completely different planet to what is going on here. So yeah, just thought it's worth mentioning because see it all over Twitter, and it just seems like everyone's losing their mind over this. The Fed is now another hot talking point because now we're getting closer to the new Fed chair nominee being announced, and also, the implications of that, right? Because now the Fed is seen to have a much more dovish composition. Trader bets swell on Trump-backed Fed, data stoking U.S. rate cuts. Not sure about the data part. We'll have to see. But so far, the case has been supporting that side of it, but I don't think an awful lot. So I think it's mostly the expectation that the Fed is going to be very, very dovish. And, they're very, very divided about where this long-term interest rate will settle, the terminal rate, and which ties into the question of the R star, the neutral rate. Um, what's the rate at which the Fed funds rate is neither too accommodative or too tight. And yeah, we're seeing a lot of disagreements, and that makes monetary policy volatility, Mon-Paul Vol, as Samuel Rhines, an economist now at Wisdom Tree. He likes to talk about Mon-Paul Vol, as well as a few other concepts that he's made very popular. And I think we're going to get that. I think Mon-Paul Vol is going to come back for 2026. I think that's going to be a big theme. You will have heard me talking about my medium-term view with respect to the dollar for next year. Everyone's talking about the death of the dollar yen going to 120, 140, all the rest of it like it's set in stone already, like it's a sure thing. I don't think so. I really think that the U.S. is going to show its exceptionalism, much more so than we're currently seeing. I think the U.S. economy is going to rebound next year because a lot of the crap that we've been seeing this year is going to come off. And you would have seen some analysis about GDP growth. If you take away AI capex, GDP growth has been rather flat, maybe closer to 0 point something percent rather than in the threes. Whether that's true or not, when you think about what's going to happen next and what happened before and what could be different and how that changes that GDP growth outlook, I think we're actually going to see some upside in growth, excluding AI capex type growth. And that would also mean that demand for labor comes back too, which means that, and I've talked about this before as well, but just to reiterate, the supply side of the economy probably won't change a whole lot, but the demand side improves alongside a rebound in growth and activity and all the rest of it. Then the labor market starts to get tight again. The growth in demand is outpacing supply. That creates a tight labor market where wage pressures are still going to be supported. And with the current wage growth running at about 4%, and the Fed funds rate just kind of being slightly under that, you have to kind of wonder whether there's much room for the Fed to cut. So that would be quite supportive of the dollar. I don't think this is anywhere near consensus view either. So I think that makes it a little bit more interesting. And of course, the discussion about the Fed, this long post, it's quite obvious that the kind of direction that we're heading with the Fed is towards a more dovish direction. And for now, that's going to be good for risk. Agree. But as I just talked about with respect to the medium term view and the longer term view about what growth and inflation and the labor market could do, I think it could get rather nasty, right? When we get that monetary policy volatility, just because it's so not consensus. It's everyone just thinks it's just going to be outright dovish Fed, and life goes on in an up only sort of fashion. So I do feel like there's going to be some dislocations as a result. The dollar being too strong, that creates a little bit of issues elsewhere. Yields rebounding. Are we going to be talking about 5% 10-year again? Who knows? It's possible. If all the stars align and all the data is good, and you have 4% wage growth, and that actually translates into strong GDP, who knows? It could happen. I don't think that's a complete tale of a scenario. So just wanted to get that out there, that this guy is going through all the scenarios, but he's not taking into account the different scenarios that could happen on a fundamental basis, on a macro basis, the data, what the real economy is doing. He's just looking completely at the Fed, and that's sorely missing from this analysis. So he's gone through all this without really covering that, and that's very short-sighted in my opinion, because given that the Fed, there's a lack of consensus, a lot of disagreement where the terminal rate's going to be, what's going to move the needle? The data. It doesn't matter how dovish these guys are. The data will speak louder than any dovish opinion of the Fed, would it not? So I think a key part is missing from there. So with that, we'll hit a few charts. I got Aussie dollar up here, but we'll come back to that. SPX. We've started to consolidate around here, and